I just wanted to see if I can turn on this, not annotation, but my smart joint. All right, it ain't gonna work. Cool. So let's go ahead and get started. Little after 6:30, I mean 5:30, sorry. Central Standard Time. I know a few people may be trying to get off work and all that. It's all good. I'm gonna go ahead and record, kind of go over some basic concepts of what options trading is and what options are. We had it in the 4-week course, we had it in the ebook, but for those individuals who probably haven't gone through that yet or need a refresher, let's give you a refresher today. I'm going to be recording this for those who aren't here. And then if you jump on as I'm going through it, don't worry. I'm gonna leave some time at the end for you to go over some Q&A if you get on and have it. So, agenda for today. Um, Introduction to stock options, sorry. Type of stock options, valuing stock options. We're going to talk about risk and benefits to stock options because risk is there too. So we just got to make sure we're tight with it. And then we're going to talk about some practical examples, giving examples of some of the things that you may have seen floating in the chat. Dunny alerts is where I call out my plays, kind of going through some of the charts and what we see, why we call out certain plays the way that we do, and how you can finally get involved here. All right, so a stock option. So really, a stock option is a contract that gives you the ability to buy or sell stocks at a predetermined price. So when we you see us talking about a stock option contract, that contract is actually the ability for you to buy or sell 100 shares of a certain stock, right? So one contract equals the rights to 100 shares. That's all we're doing. And so when you see us saying we're paying $300 for a contract or $400 for a contract, we're actually paying a premium for the right to either buy or sell those contracts or those shares within that contract if we decide to do so. That's all we do with stock options. We're just buying premium, selling premium to somebody else at a higher price later on. So it's like people who do like wholesaling in real estate, same thing, or buying a contract on, somebody's rights to a movie or something, whatever it is. It's like, man, we're just licensing these shares for now, and once they get to a higher price than what we paid for them, we're selling them off to somebody else. That's really all stock options is. That's the main way of playing stock options is the premium play, and then we'll talk about also, executing the contracts if you decide to do that and actually buying the shares within those contracts. So the way that we look at stock options is we're just speculating on what we think that a stock is going to do, right? Is if it's going to go up or if it's going to go down. Now, when I say speculating, I don't want you to think that is guessing. There is some guesswork into it, but we talk about things like technical analysis, fundamental analysis, and catalysts to give us educated guess, right? If we want to call it a guess, so it's really utilizing those things to increase our probability that an option is going to go in the direction that we want it to or that we assume it's going to so we can actually profit off of it, right? And so when we think about technical analysis, that's the charts. Fundamental analysis, you may remember this from our videos, that's what is a stock, I mean, what is a company actually doing? How are they actually performing, right? Are they profitable? Are they beating earnings? And then catalyst or news that happens in the market. Like the last couple of weeks, the catalyst of news has been the tariffs, and we saw how that made the market go up and down. So those are really the three things that we look for. And then that fourth one is once you become a trader and you get time into the game, it's going to be that gut feeling that comes along with it, right? And then don't worry about the employee incentives. That's other type of stock options. So we're really just focusing on it from us as a trader. So when we talk about some of these different terminology, right? So you may hear us say, man, we're going out to get into this contract expiring on this date with the strike price, right? So what the strike price is, that's the price that we think the stock is going to go to, right? So today you may have saw at the end of the day, we did this put that said, hey, we're going to do a put on, I forgot, I think it was UPST for $86. So that strike price is us saying we think that UPST is going to go down to $86. That's going to be our strike price, and our put is the direction that we think is going to go. And then the expiration is like how much time am I going to give this contract to expire, or how much time am I going to give this stock option to actually play out in my favor. And so for that one, we said 2/14. That means February 14th. So I'm going to give it a day for it to go in the direction that I think it's going to go. And then we talked about it on the first slide. The premium is how much is it going to cost me for the right to actually buy this contract that I believe is going to go in my direction. And once it goes in my direction, I'm going to sell that premium to someone else who think it's going to continue going in that direction and take my profit from there. And then the underlying asset is just really the stock that we're talking about, right? So we're buying a premium for the right to 100 contracts on the underlying asset of whatever that stock is, and the underlying asset is that stock. So that's the basic terminology. So how do they work? So again, it gives us the right to buy an asset at a predetermined price, which is the stock price. And there's two main ways that this goes: stock calls and puts. Right, calls, we believe that the stock is going to go up. Right, we're calling it up. We're calling somebody up from the G League to the NBA. So call is picking up the phone. Puts, we believe that a stock is going to fall, or is going to go the into the negative or whatever that is. That's a put, right? And then the profit mechanism is the price fluctuation. So a price fluctuates and it gives us that spread in our direction. That's how we profit from a call or a put in the stock options world. Now there's so many different other ways of advanced trading, but the simplest form, the most widely used form, is calls and puts. Or you may hear, when you look at like Yahoo Finance or CNN Money, they say shorting or longing. Same thing. Longing means we believe it's going to go up. Shorting means we believe it's going to go down. Same thing in essence as calls and puts. So I'm going to stop there. I see someone's jumped on questions. Really want to make this interactive. I was just going ahead and recording until people start falling in, as they may. But if you're already on, go ahead with your questions. We can pause there, get some clarifying. If you've seen things going on in the chat that you don't have, a full understanding of, that's what this is for. Come off mute if you're on and you got an idea or got a question. If not, I'm going to go ahead. If you're talking, you're on mute, and I can't hear you. All right, cool. All right, so talked about call options already, right? So we believe a call option is when we believe a stock is going to go up. And so what this does, again, it gives us the right to purchase the underlying asset. That's really the thing, is the big boys, they do this to purchase the underlying asset at a specific price. Like you may see Nancy Pelosi and they like, man, she just bought, $1 million worth of options on NVIDIA for $94. The reason why she does that is because if NVIDIA blasts past $94 and gets to $150, where we're buying and selling premium, she's going to exercise her right to own those shares at $94. And so that way now she has $1 million worth of NVIDIA shares at $94. She's not worried about the premium, because if she believes NVIDIA in 4 years is going to get to $500, she can then sell those $94 shares that she has at $500 5 years from now, and just hold on to that and not have to worry about the time and the expiration that we deal with when it comes to trading premium for premium. So that's another way that people can do this. For instance, a great example of that was Palantir, right? Palantir was $30 back in August. So if somebody said, hey man, I'm going to buy a contract for 100 shares of Palantir with a $40 strike price. So once it gets to $40, I can exercise that. And now I have 100 shares of Palantir for $4,000. Well, now we know Palantir is $117. So it may have cost me $4,000 for those shares and maybe $1,500 for those premiums, for that premium to buy the shares. So now I'm at $5,400, $5,500. But now that Palantir is $117,000, I can now sell it at that price and still that, $11,000 minus my 5,500, I still profit $6,000. So that's another way to play the game, is to do it if you believe a stock's going to go up over years and say, hey, once it gets past this price, I'm going to go ahead and execute this and own these shares instead of selling premium to premium. So that's another way that individuals use stock options, is to get owning shares at a low price or just selling premium to premium, which we do a lot of in the group chat. So So puts are the same way. It's just the opposite of it. Hey, I can buy a put to say I believe that this stock is going to go down to, from 50 to $40. So my strike will be 40. And if that thing drops to $10, now I have the option to say, dude, I can sell this stock that that I had the rights to at $40 to somebody else a lot lower and get the premium that way. All right, so valuing stock options. So there's a couple of ways stock options are actually valued, right? The intrinsic value is a calculation, right, of the current price of the asset and the strike price. So the value of it, again, if I see something at $10, but I believe it's going to go to $4, that $4 difference, since I have 100 shares, is the value of $400 in profit for me, right? So that's how we calculate the value of what a stock option is going to be. Now, here's the beauty of stock options that a lot of people get confused. They feel like if I see something at $10 and I got a strike price at $14, I won't make money until this thing hits $14, which isn't true. With stock options, since the underlying deltas, I mean, sorry, the underlying Greeks or dynamic, they change. So as a price starts, if it goes from $10 to 11 to 12, more people are going to believe that this stock is going to continue and actually get to that $14. So they're going to start piling money in and they'll be willing to pay you for your premium at a higher price at $12 because they believe it's going to continue going. So you can actually start making money, once that thing gets even to $11, you can cash out and make your money. So you don't have to hold two things you don't have to do. You don't have to hold a stock option until it expires, and you don't have to hold a stock option until it actually hits your strike price. You just have to get it and make sure that it's going in your direction. And then at any moment that is moving in your direction, you can go ahead and sell it for a profit. That's the beauty of this thing. And that's one myth to be dispelled, is that you don't have to hold it through expiration, right? I have contracts that are, like, for instance, the Microsoft contract that I was in, it didn't expire until the 21st, which is next week. But I got 20% into the money today. So I'm just going to go ahead and sell it. I'm 20% in, made the money that I'm happy with. So there's no need for me to continue holding it for another week. Will it go up? Probably. It probably will go up and make more money. But if I can get 20% in, holding something for 2 days where the stock market barely gets that on a great year in a year, I'm going to take that money. So that's how I play the game. All right, so the time value. So this is what we're talking about, right? The time value within a contract. So another thing is that depending on what the theta is, which is your time decay, which means how much does a contract lose if it goes against you each day that you hold it. So another thing, I don't want to get close to the expiration date because you start losing value the closer you get to the expiration date. That's why I tell people, when you see profit and it's what you want as a profit, go ahead and take that. We don't have to hold it to expiration because you start losing value the closer it gets to expiration, especially if it's not near. Let me put chart thing up. Especially if it's not near your strike price, because again, that time decay is going to start eating at you. So it can work in your favor and it can also work against you. Now, another thing with the time factor, let me go back here. Another thing with the time factor is, you may see sometimes where we say, hey, we're going to do this 0 day, or we're going to do something that expires in 2 or 3 days, because they're cheaper, right? And then as they move in your direction, your percentage adds up a lot faster in a shorter time frame than it does in a longer time frame, because it accelerates. If it's going in your favor, it accelerates faster when it's closer for you. But it also, if it's going against you, it's going to eat away at you faster the closer you are to the time decay, to the time element. So sometimes those short time plays actually work great because, again, the percentage runs up pretty fast. But for those that are getting newer, or just now getting into stock option, you want to give yourself more time. Yeah, you may only get the 15 to 20% on it, but it gives you more time for the play to develop for you, and it's easier on the nerves. Trust me, the 1 and 2 days, they move a lot faster. The percentage moves faster in your direction, but again, if it goes against you, it eats you up very quickly too if you don't have a proper stop loss, and we'll talk about that when we get into risk mitigation. So what affects options pricing and the direction? Number one thing is the volatility of the underlying asset, right? If you see like SPY is going up and down, that affects the price of options, right? If it's wicking very fast and going up and down very fast, and it hits, a certain area very quickly and rejects, it's going to go, that price, if you're still in the call when that happens, you're going to start losing value very quickly if it's very volatile. So you want to make sure that you do trade things that have a moderate amount of volatility, but not things that are super crazy volatile. Because again, number one, the nerves. Number two, how quickly things can change when it comes to price fluctuations. Talked about the time till expiration, and then of course market interest affects stock prices also because you have to factor that in, right? If interest is higher, premiums are going to be higher because basically what we're doing is borrowing money when it comes to premium to premium. That's all we're doing is borrowing money. All right, risk. Let's talk about the risk and benefits. Number one, the benefits of it is that it allows you to actually accelerate your earnings because remember, each contract that you're buying represents 100 shares. So if I had one share of Tesla and it went up 20%, let's say Tesla's $100 and it goes up 20%, I make $20. That's good money because it's 20% if you're looking at the percentages. But if I have a contract, that represents 100 shares. So that 20% now turns into, $200 because it's the 100 shares that's represented. So it accelerates very fastly, more fast for you as far as your capital return on investment. And then there's the flexibility. We talked about the various ways that you can approach it, right? You can sell premium to premium, or you can actually, if something you say, I believe it's going to go to $10 and it rockets up to $40, now you can buy those shares and say, wow, I have 100 shares of this stock at $10 now. And if it continues to go, I don't have to worry about time decay. If something like, let's go back to Palantir. Something like Palantir that just turns out to be this monster company now that nobody really, we had an idea, but nobody really knew it was going to go from $14 to $117 within the span of a year. So if you had that option, now you can hold this and say, okay, this may be around for the next 4 years. So instead of $117, I'm gonna hold it from $10 until this thing becomes a $500 stock. Then I'm going to sell my 100 shares. Now you have all that profit that you have because you held those shares at $10. So those different flexibilities. We talked about the high return potential, and that comes from the ability to leverage that investment because you're representing 100 shares instead of one. And then the risk hedging. This is what I do with options. When I have long-term portfolios like my Microsofts, my Amazons, my Googles, my Nvidias, when I start seeing those things go down, I don't worry because these are long-term plays that I'm holding, right? So I don't worry about the Nvidia fluctuations. You may see like last week it dropped down to 116, or the week before now it's right back to 140. I don't worry when it drops to 116 because I plan to hold this thing for years. But the way that I use options when it's dropping is that I'm going to do a put. So when I do a put, I'm not worried about my long-term shares. Those are going to be good. I'm just going to ride the market down, 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 and then I'm going to cash out on that premium. So now I have more money from that premium to go buy more shares of Nvidia at a lower price, or I can exercise that option and buy it at a lower price, right? And average in even better. So it's also a risk. A hedging mechanism when it comes to trading options against your long-term portfolio that you're holding on to. All right, so let's talk about the risk, right? So we can't say, oh, this is all rainbows and butterflies because there are risks associated with it, right? Every investment, everything that you do is going to have a risk of losing money. So you have the risk of losing premium that you paid for a call option, but you can't lose more than what you paid for the option, though. That's the plus side of it. Now, as you can see here, you have the risk of losing the premium if they expire worthless. Remember, I said a couple slides back, we don't wait until expiration date. When we get into the profit, we get out. We're not going to hold these things till expiration because each day the value does this. Every day that it gets closer to expiration, and you do run the risk of if they expire at zero, you lose your premium. So we don't do that. Another thing is we set things that's called a stop loss. A stop loss means that if a play or an options contract that I think is going a certain direction, and maybe I miss something and it reverses against me, we're going to set a stop loss that says, okay, if I paid $100 for this premium, I'm not going to lose $100. I'm going to stop loss at $10, and so I lose $10 and I'm out. Right. So that's how we mitigate risk. And then the other piece of risk is the market volatility. This is another reason why we're such sticklers um on having stop losses because sometimes markets get volatile. Again, a couple of weeks ago, the market was going towards an all new time high, and then the president says we're going to impose 25% tariffs on, Canada, Mexico, 15% on China. Nobody could have seen that coming. And then what happens? Market volatility, and we see a drop in the market. Now, if we didn't have a stop loss, we would have lost our premium. But since we said, hey, we don't know everything that's going to be going on in the market at all times, we're going to set a stop loss. So when that happened, we only lost 15-20% of what we paid for the contracts, live the trade another day. But then what it allowed us to do is say, cool, now I have capital still because I didn't lose it all. So since this market is falling off, the next day we're going to find the bottoms of that market and we're going to do calls and we're going to give ourselves more time for the smoke to clear. And we're going to ride those calls up for a couple of days, couple of weeks, and we're going to make that lost 15% back plus, another 50, 60, 70%. That's how you play the game for risk mitigation, just like anything else. So we talked about this, right? The stop loss orders, diversification, right? If you want to if we're looking at the stocks and something falls, right? A lot of times there are different indices and stocks that go against each other, right? So a lot of times when we see the market fall, we see gold stocks go up or oil stocks go up. So we look for those things too and say, okay, if I'm in a call that I think the market's going to go up and it's pulling back, well, I'm going to get into something that goes the opposite, like gold or oil. For me, if I hit my 15% stop loss on this, cool, I can make 30 to 40% this way, and it's going to balance this out and still keep me profitable. So that's other ways that you can think about it for diversification when you come to trading. And then the last and the biggest thing about risk management is you have to set clear objectives. You may see me in the chat all the time when I see somebody trading not two, that's not a lot. See somebody trading 4, 5, 6 times in a day. I'm always asking, what are you doing? You're over trading. Why are you doing this? What was your objective coming into the day? What is your goal for your profit for the day? What is your goal for the profit for the week? What is your goal for the profit for the month and the year, the quarter, whatever you have as a plan? Stick to that plan. And so I get it. Sometimes, the market's moving a lot and you see other people winning and you start gambling a little bit. That's what I don't want to happen at all for anyone. So that's why sometimes I get in there like the young big brother in the group and say, "Hey, stop trading. You're trading too much. You're already profitable. Take your win, shut your laptop and go to the gym or go eat lunch or something. You don't have to trade. First of all, you don't have to trade every day. You don't have to trade so many times a day." That's another thing. The group is active. I understand it's a lot of moving parts. It's going to be very hard to not want to jump in, especially when you start doing this and you start making money. It's always more and more and more and more and more. The market doesn't have to respect rules. We do. That's one thing I say over and over and over. We are the ones that have to stick to our rules. The market does whatever it does because it's an algorithm. It's man versus machine. It doesn't have rules. We do. So when you set a goal for the day, or you set a goal for the week, or heck, even a goal for the month, if you get into a great trade and you swing that trade for 2 days and you hit your goal for the week, stop trading. You hit your goal for the month, stop trading. Discipline. You rather make money being disciplined than make money being undisciplined because that reinforces bad habits and you think that you're doing something right and you're really not because you're an undisciplined trader. So stop trading. And then what I say to a lot of people is if you hit your goal for the day or for the weekend, you want to keep an eye on the market, cool. Go back to paper trade. And what that is simulated trading. Every platform has it. I think it's in week 3 or something of the videos, or maybe it's in our after the videos, but we have a lot of videos on the different platforms on how to do simulated trading. That'll keep you sharp if you want to do that. It's like going to the gym and putting up shots, but you're not actually playing in the real game. Simulate trading, make sure that you're sharp, make sure they're actually doing what you think you're doing and that you actually are following your rules if you want to continue to keep an eye on the market. So in conclusion, we talked about the power of stock options, right? That give you a great opportunity to either buy shares at a certain price or buy and sell premiums and make good money. Once you get this down and once you stick to your rules and you get that discipline, you can make very good money trading options. I mean, like, even if you come in and say, I don't need to get rich for this, but if I can trade and make enough in the month to pay my mortgage, that's all I want. That's a level of freedom. You don't have the stress over your head if you can get in and do 2 or 3 trades in a month and pay off and have enough to pay your mortgage or your car note. That's a stress reliever, and that's a type of freedom that a lot of people don't get. So, and it's very, very feasible in this game. It's just about the discipline and sticking to the rules. The reason why they say, the stat is 95% of traders are unprofitable. Yes, that's a scary stat, but the reason why is because most of the traders don't come in with discipline. They want to jump right into the money from the jump. I'll just learn and lose as I go, and that's not the way. When I started, I paper traded. I paper traded for a long time until I got the emotional discipline down to get into this thing with my real money. And any time that I ever lost money, it was when I went against my rules and I didn't stick to my discipline. That's the only time I've ever lost money. It's never been sorry, not lost money, lost a significant amount of money. It's if it was it had nothing to do with the market. It was me not having a stop loss, right? Because losses are going to happen. But here's a crazy statistic. Let's say you're a trader, you get into 10 trades, and you only are profitable on seven of those trades, right? I mean, sorry, not seven, only profitable on three of those trades. The other seven, you lost 10%, right? Let's say you put up 1,000 every trade, you lost 10% seven times. You lost $700 doing that. But on those other three trades, right, you made 40%. So you got $1,000, remember? So that's 400, 400, 400. That's $1,200. Even being a 30% profitable trader, if you have a tight stop loss, like a 1 to 4 ratio, and you make 40%, that's 1,200 minus 700, you're still profitable $500. So even if you're a terrible trader at 30% win streak or win rate, sorry, you can still be profitable in this game as long as you follow your rules. But we're not going to let you be terrible because I have dunny alerts and I have a very high hit rate. If you can go back and look at the videos, I don't know what I'm batting at, but maybe 70 to 75%. So now if you do that same math and you hit at 70%, I mean, seven times of that for 40%, you're at $2,800, right? Minus the other $100 that you lose of 300, now you're 25% profitable. That's how those things can change very quickly as long as you're disciplined. So understanding the mechanics, right? The different types of stock options, if you want to be, calls, puts, decide what you want to do, decide what you want to be, and then just being informed about the decisions. And we try to drop as much knowledge as we can on the daily. I do my pre-market videos of what I'm seeing in the market, what I'm doing, what I'm leaning towards, and you'll see if you start following along and get into the main chat, you'll see I'm very patient. A lot of people want to jump in right when the market opens. They get antsy. I say it, I like to stalk the gazelle, right? I'm a lion. I want to stalk the gazelle. I'm going to take my time and be very patient until I see what I like to see. And that's trading off certain patterns. And we'll talk about that in the other videos as we go along and have these calls and get you guys up to speed. You'll start understanding the patterns that I look for. And if I don't see them, I don't rush. I wait. There's sometimes I don't even get into a trade until the end of the day. There's some days I'll skip, but I make up for it on the next day because my pattern actually plays out and I make the money that I would have made over the last 2 to 3 days. So it's all about the patience and it's all about discipline. So with that, I want to stop there, open the floor. I see that you joined. Unfortunately, you're the only one that joined. We're trying to get people to get involved. People are paying money. We want you making money. I get sometimes schedules are hard and we'll work on maybe do a poll and see what works better for people's time. But since you're on, the floor is yours. You got me to yourself. Let's dive in.
Man, I appreciate you, Chris. I just the thinker that what was it, the paper trading options. I had an account with Thinkorswim, but I guess it was just for like just that 1 month. So is that
Okay.
something? Is there another space that I could go to? Like I don't know if Robinhood has it. That's who I really be
Yeah, so
doing.
think
That's
so
the
even with the
platform that I have.
Thinkorswim, I think what happened with Thinkorswim is they switched over to Charles Schwab. So your same login information will work with Charles Schwab.
Okay.
So you have it.
And
Um,
okay.
I know that Webull does paper trading. I'm not sure if Robinhood does. Let me see real quick. Um, Robinhood. Yeah. So Robinhood doesn't have it, but what Robinhood does have is it allows you to like do a trade watch list. So you can do a watch
Okay.
list and say, okay, I'm thinking that I want to get into this. This will be a play I get in. I'm gonna add it to my watch list, and then it'll show you like how it performs over time. You can do it that way. But to really get some good simulated trading, I would say Webull and then logging into your Charles Schwab.
Okay.
Yep. Is that all your questions?
That's it for now. I just haven't dived in, man. I'm just actually last night I bought some shares of I think you sent something about the Round Hill ETF.
Oh yeah, yeah. The one that has the Max 7.
Yeah.
Yeah, yeah.
So I bought some shares of that last night. Just little. So I didn't know exactly how much I should be utilized. So I probably spent like $100 there and $100 in the TSF or something like that.
Yeah, man, it's your own pace, right? It's your own race for real, especially if you're new to it and just getting used to it. It's your own pace. Now, what I will say is like once you start seeing those things perform and it's like, oh man, I'm up 10% or 15% on this thing, you're gonna start saying, okay, I'm gonna buy more. I'm gonna buy more. And what I
So
typically tell people is just, just do it consistently. The market, when it comes to long-term holding, it rewards you for holding consistently, right? So
okay,
every month you want to put a little bit or every paycheck just put a little bit in and you'll start seeing that growth and that growth of the market that it's going to give you is it'll blow your mind, man. I was just talking to someone earlier who wants to make sure like their kid is set for life, right? Their daughter's 3 years old. And I told her,
yeah,
I said, if you start putting $100 into the S&P 500 for your daughter now at 3 years old, and you only put $100 in per month, based on how the market has performed over the last, 60, 70, 80 years, by the time she's 21, she'll have six-figure portfolio. But that's not the kicker. She could stop investing then, right, and then just let it continue to grow just based off of the interest and the growth of the market naturally. And by the time her daughter's 42, she has $1 million portfolio for putting no more money in. Now, if you imagine, her daughter getting 21, getting her first job and matching that, right? Now the million's at 30 years old, or 2 million if you're adding a little more. So that's the beauty of consistent investing, that the market's going to actually reward you with natural growth, because the goal of the market is to return, ROI to people that invest in it, because the market is pretty much the backbone of America, the market, oil, and our military.
gotcha. Yes, sir. I appreciate that information as well.
Yeah. So, yeah, man, if that's all you have, I'll let you get back to your night. But, as you see, I'm very active in the chat. I know you send me a couple of IMs, and I don't always see those because there's so much scamming going on in this space. I try to
Yeah.
keep my DMs blocked so no one gets caught up thinking it's me. So
Well,
if you
and
have the
that's what
question,
initially happened. So I was messaging somebody, and I thought it was you, and then he was like, "Well, you ain't got no money now." I'm like, "No, I ain't got no money." I'm like, that didn't sound like your demeanor at all." So I'm just like, "All right, let me chill." Then the next day, you sent the message about scamming, and I'm
yeah.
like, "Oh shoot, that's who it was." That's why I messaged you like, "All right, is this the real you?" You like, "Cool," and I kind of kept it there, but
Yeah,
I'll be watchful on that.
yeah, it's dangerous, man. Because I mean, they're everywhere, man. I got them here, Instagram, everywhere, just trying to scam people. And I try to reiterate every once in a while, like I'm not DMing anybody, right? As you can see, I'm active in the chat. I'm active in the new chat. So if you guys have questions, just tag me there. If you hit the at function and
Uh,
and do my name, it'll tag me and it'll alert me that somebody's asking me a question. But I try to stay out of DMs for that reason. You're right, across all platforms.
gotcha. All right, bro. I appreciate that.
Yeah. Cool. So if that's it, like I said, if you have any questions, just drop them in the chat. If I don't get to them, Mike's an admin, Dave's a junior admin, and we have others that are in there that'll get to your questions for sure.
All right, appreciate it.
All right, man. Have a good one.
Thanks. You too.